Is real estate still the safest path to wealth in 2026? Or are the sands shifting beneath our feet? From REITs reshaping income strategies to rising rates testing homebuyers, today we uncover the opportunities and the risks that could define your next big investment move. Welcome back to AmosFinance, where insight is turned into action. I'm John Hawk. If you want future-ready insights that cut through the noise, hit that subscribe button so you don't miss what's coming. In 2026, real estate sits at a crossroads. Inflation has cooled, but interest rates remain elevated. Central banks in the US, Canada, and the UK are signaling caution, keeping borrowing costs higher for longer. That means real estate isn't the easy win it was a decade ago. But here's the twist. For investors, these same challenges are creating fresh opportunities. Let's start with REITs, real estate investment trusts. They've become the gateway for investors who want exposure without owning physical property. In the US, Realty Income, nicknamed the monthly dividend company, continues to attract income seekers. In Canada, residential REITs like Capriate are positioning themselves for demographic tailwinds as urban populations grow. And in the UK, warehouse and logistics REITs are benefiting from e-commerce expansion. The key here? REITs let you ride the real estate wave without the heavy upfront capital. For residential property, affordability is the elephant in the room. In Toronto and London, high rates have sidelined first-time buyers, but this has created demand for rental housing, boosting rental REIT performance. In the US, markets like Texas and Florida continue to grow thanks to migration and job creation. For investors, the lesson is simple. Follow demographic shifts, not just headlines. Commercial real estate is splitting in two. Offices are still under pressure as hybrid work reshapes demand. Vacancy rates remain stubbornly high in cities like San Francisco and London. But warehouses, data centers, and healthcare facilities are booming, driven by e-commerce, AI, and aging populations. Smart investors are pivoting away from struggling office towers and into specialized REITs that thrive in these new growth sectors. Policy is the wild card. In the UK, reforms around planning and green building codes are shaping supply. In Canada, immigration remains a key driver of housing demand. And in the US, tax treatment of REIT dividends continues to make them attractive for income investors. Wherever you are, policy direction will decide which sectors win and which stumble. So what should you do as an investor? 3 things. 1. Look at REITs with exposure to logistics, data centers, and residential rentals. 2. Track demographics. Where people are moving, demand follows. 3. Stay alert to policy shifts, because regulations often create both risks and opportunities. Real estate in 2026 isn't collapsing, it's transforming. The investors who adapt, win. The ones who hold on to yesterday's playbook risk being left behind. In my next episode, we'll explore how automation and the future of work could completely reshape demand for real estate, offices, and even cities themselves. You won't want to miss that. So, make sure you subscribe, hit the bell, and join me on AmosFinance for the insights that keep you one step ahead. How do you plan to maximize 2026 real estate opportunity with AI shaping the globe?